Hi, this is Nick Katko from BMA, and welcome to today's webinar. And the topic of today's webinar is dealing with standard costing, a step-by-step methodology. Over the years, I've learned that standard costing in lean manufacturing organizations is a very complex issue. And so what I want to do today in the webinar is explain how you deal with this. And this is not just for accounting and finance people, this is for the entire organization. So I have three learning objectives. Number one is for you to learn methods to eliminate waste in standard costing systems. Number two is to be able to explain why lean inventory valuation methods comply with generally accepted accounting principles. And number three is understand the different types of lean inventory valuation methods which you can employ in the future. Our agenda today is quite simple. There will be a brief introduction, sort of the background of standard costing and lean organizations, talk about a few important issues. Then we'll get into the details of specifically how can you eliminate waste from your standard costing system? How can you actually go about eliminating standard costing in your system, in your company? And then we'll finally wrap up and take some questions. In order to deal with standard costing, it's important to apply lean thinking principles and practices. That's really, I think, the only way you get through this, because what we're trying to do really is solve problems, okay? And it's really multiple problems over the course of time that we need to solve. So the typical current state is that you have a traditional based management accounting system. It's based on standard costing. Set a near-term future state. And the goals of the near-term future state should be to eliminate standard costing from your management accounting system and to apply lean practices in terms of problem solving and waste elimination to your standard costing system. Your future state is to eliminate, long-term future state is to eliminate standard costing. And I bring this up right now because many companies in the current state try to take an immediate jump and try to solve the problem and try to get to that long-term future state quickly. And it's very difficult to do because there's many issues you have to deal with. So I strongly encourage to focus on the near-term future state. You still have that goal of the long-term future state, but don't try to figure out how to get there immediately. Few random thoughts before we get started. The topic of standard costing in lean organizations is still very much misunderstood. I think that's because standard costing in and of itself is a complex topic that not everyone understands. Obviously, accounting and finance people understand it, but I think other parts of the organization aren't very familiar with a lot of what goes into standard costing. There's confusion and misinterpretation of what the phrase eliminating standard costing means. I've heard companies use that phrase, and a lot of people in the company really, they go like this, what does it, what are we going to do? And that's really because they don't know what the alternative is. So, as I said a few minutes ago, maybe avoid talking about that at the beginning of the lean journey. There's the functional view and the organizational view of standard costing. Operations looks at it one way. Finance and accounting looks at it another way. Supply chain may look at it another way. Leadership may look at it another way. So I think what's really important before you can start focusing on improving and eliminating is get a consistent, concise organizational view of what a standard costing system is. And finally, leaning out standard costing and or eliminating standard costing is a process, and there must be a plan. And I think it's very, very important for finance and accounting people to be the leaders in developing the plan. One way to think about management accounting is through a lean viewpoint in terms of waste. Where's the waste in your management accounting system? A very simple way to look at waste is to remember the word downtime. D stands for defects. In most traditional management accounting systems, the information is not totally aligned with lean and often is incorrect, meaning it can lead you to very, very wrong or inconsistent decisions. Overproduction. Think about all the unnecessary work steps in setting up a management accounting system, maintaining it, reporting transactions to it. A lot of work there, which cuts across the organization. Long feedback loops. A lot of the information in management accounting systems is not instantaneously available, such as on a visual board, and sometimes it takes time to get that information, and so long feedback loops in lean organizations are not good. Neglect of human talent. I think this is the biggest waste in a traditional management accounting system, in the fact that nobody's trying to improve it to create value for your internal customers. Most manufacturing companies have had management accounting systems for a long time, and that's just the way they are. We just run them. There's a lot of movement of information. It's reporting transactions from systems to spreadsheets to reports. A lot of information moving around. You think about inventory in terms of batch processing, that annual process of setting standards, rates, or allocations. That's batch processing. How many meetings in your organization are around standard costing information? This may be group meetings, this may be one-on-one meetings, this may be phone calls or emails, but just think about all the meetings and how much people talk about these numbers. And many reasons they're talking about them is they don't understand them. And finally, there is the maintenance of the system, which is very, very complex. So there's lots of waste and lots of opportunities to improve. The other aspect of lean thinking applied to standard costing is to begin with principles. So what are the principles of a lean management accounting system? First is customer value. A lean management accounting system needs to provide relevant and reliable information to meet customers' needs, internal customers. Relevant information to make decisions or do an analysis. Reliable information means it represents reality. And that's one of the problems in traditional standard costing systems in a lean organization is the information from the standard costing system does not represent reality. Flow and pull. The idea behind a lean management accounting system is to get the right information to the right people at the right time, at the right place. There's lots of decision-making and analytical activities going on in any organization, and especially a lean organization where you might have daily huddles and weekly meetings all through the business. So we got to get that information there, and it has to be available when it's needed. In terms of quality, what we're trying to do is improve the analytical and decision-making practices in the organization. We want to get better at being predictive in our decision-making, knowing what the outcome is, and also in our analytical practices, especially if we're looking backwards and trying to explain what happened. We want to be able to be clear and concise about what the root causes are. And improvement. We want to continually improve our management accounting system to better align it with the lean strategy. So those are the principles of a lean management accounting system. When you think about accounting's need for a standard costing system, there's three components or three areas that it's used. One is inventory valuation, and that really is the reason standard costing systems exist, is to value inventory. It's a simple way to do it because it's all automated. Now, there's a lot of complexity in setting it up, but it just runs by itself in the system. A lot of the standard costing information, though, can be used to analyze profitability. One example is what's the margin of a specific product. You can get a price, you know what the standard cost is, you can get a margin. That's a simple example. Also, standard costing systems generate a lot of operating performance information, which is really based on mass production methodologies. Numbers like variances, numbers like absorption, and most of this is actual against standard. So from a lean viewpoint, we don't want to use standard costing information to analyze profitability or operating performance. We need our lean management accounting system to do that. However, in the near term, we still need standard costing to value inventory. So let's talk about how we make all this happen. First is eliminating waste in standard costing systems. This is the near-term future state. What do we want to do? What does this mean, eliminating waste? First, what we want to do is stop using standard costing information in management accounting. I mentioned that a few minutes ago. I'll probably mention it about 3 or 4 more times. We want a lean management accounting system that is standard costing free. Now, we also want to stop analyzing variances and absorption. Just because you create a lean management accounting system, if you're still using standard costing to value inventory, you're still going to get variances and absorption. Now, I'm going to show you some examples of how maybe you could reduce that, but you're not going to eliminate that. So really the key is to just don't analyze them anymore. Yes, they appear on the financial statements, but we know why they're appearing. It's a product of the system, but the numbers really don't mean anything. Do they impact profits? Yes, but they really don't mean anything. We want to reduce or eliminate unnecessary ERP-related transactions. And what we want to do is simplify rate setting. So let's look in detail at how we can do some of these things. So we're going to talk about some ERP issues here, how you configure your ERP system. And what I'm going to be talking about over the next few slides are all examples of improvements that have been made in ERP systems to reduce unnecessary transactions and eliminate some of the waste in standard costing systems. Now, some of these practices I've done, some of these practices I've seen other companies done. So these are just examples. And what's really important is that you have to do things in your company, but this gives you some guidelines of what can be done. So if you look at bills of material, which are used to calculate the cost of material, first of all, there's the quantity of bills of material. Now, in a traditional or conventional manufacturing organization, you have a bill of material for every item that gets reported as inventory, whether it's whether it's a subassembly or a finished good. From a lean viewpoint, if we go to single piece flow and make to order, we have an opportunity to maybe reduce the number of bills of material to just finished goods only, because we might be making subassemblies, but they're not really holding in inventory very long. Maybe they're not even going into inventory. They're just going into the finished good. If you have custom products or one-time products, sometimes your ERP systems have features such as configurable bills of material or one-time bills of material, where you could take an existing bill of material and make a quick substitution, but not have to go through the whole setup. If you have a lot of custom products and you're building a bill of material for every custom product, it's a maintenance nightmare. So these are opportunities to reduce the number of bills. Then there's the line items on the bills of material. Again, every item that's purchased and all the sub-assemblies, that's traditionally how we set it up. What can we do? Well, when you put every possible item, every possible purchased item on your bill of material, that's really for traditional MRP planning purposes to let you know when you're going to have to order more material. Well, if you're working in a lean practice in operations and you're controlling material using Kanban systems, for example, you have the opportunity, maybe you can expense certain small items and turn them into more consumable supplies. I'm talking about nuts and bolts and some liquids, things that really don't add up in terms of the value of inventory. Also, eliminating sub-assemblies will reduce the line items. Then you have the quantity per assembly on each of the line items. And a lot of that, again, is for MRP replenishment purposes. We want to put yield rates in there, so we take into account scrap and items like that. And just use the actual quantity. That's simple. Finally is the price. We can determine standards and spend a whole lot of time on that, or we could reconfigure our ERP system to last price paid or maybe average cost. So that takes care of the material side. Let's look at labor and overhead rates. And it's very, very similar. You know, your labor and overhead rates they use routings or routers. So we have a router for each part reported as inventory. So if we reduce the number of sub-assemblies, we can just have a router for finished goods only. Then there's the line items in the router, which is really the production path that the product takes through through operations. So, you know, each production step is a separate line item. A lot of that is done for reporting and control purposes. How can you minimize your router steps? How can you have maybe one line in your router, make the product? I think there's opportunities if you are flowing and you're flowing fast, you don't need all those steps because the product is moving. You really, you know, your work in process inventory, if you are in a high volume manufacturing setting, may be really, really fast. And this is something that I did when, even before we started the lean accounting journey, is we collapsed our routers to really just have like one or two steps. And that makes things a whole lot easier. Then there's setting the run rates, because you have to put a run rate in. So again, the run rate, which is the time in each production step, a lot of times this is, you know, you try to include setup or changeover time. You try to maximize absorption, because that's very, very important in a standard costing world. Just use the actual cycle time on the value stream map. And finally, we get to the rate setting, where we have detailed rates to try to get accurate product costs. Well, the goal would be to minimize rates and minimize cost allocations. Can you have one labor rate for your entire facility? Can you have one overhead rate for your entire facility? The answer is yes. And the reason is that we're moving away from, in lean accounting, we're moving away from we're moving away from trying to get accurate product costs because we don't use those in decision making anymore. We're trying just simply to value inventory. And so fewer rates means less work, and you just let it happen. And what's interesting about this is if you minimize the rates and minimize the cost allocations, you really don't see much. Your inventory is not going to change significantly. Now, where would you see that? You would see that in each product cost, but we're not looking at that anymore. The final step is work orders, which is a lot of the transaction processing. So again, the quantity of work orders. In a conventional manufacturing facility, this is MRP driven. MRP creates the work orders. They try to batch the items, and every item that's reported as inventory at any point in time needs to have a work order. So in a lean environment, if we're make to order and we're flowing, how can we link work orders to sales orders? Because from a lean environment, that's what we're working off of. We're not worried about batching. We're trying to just make to order. Reporting completion. Report at each product step. That's your traditional work order. How can you have, and this is related to routers, how can you, one, backflush? I know a lot of companies do backflush, but the question is how many steps are you backflushing at? What you'd like to do is have a two-step backflush. You open and then you just complete and nothing in the middle. Then there's reporting actual. And this is where you have a detailed work order, lots of routing steps. You're reporting, for example, actual labor to each of those steps. Well, we want to stop that, okay? We want to eliminate the reporting of actual because really reporting actual to a work order just creates a variance. So in the near term, these are things which you can begin early in your lean journey. This is the near term future state. Remember, everything that is listed on these previous slides and on the conventional side are really related to traditional uses of MRP and accurate product costs. So now let's move on and let's talk about how do we eliminate standard costing. And this is related to the valuation of inventory and how do we record cost of goods sold. So what does eliminate standard costing mean? First of all, the primary outcome is we want to stop capitalizing labor and overhead product by product. And I'll explain how we can do that. We want to simplify our method of capitalizing material costs. And we want to determine, you want to determine the best method to use for this company. This is very, very much company specific. And I'm going to give you lots of examples, but you're going to end up having to decide what's best for your company. But before we get into the details, let's talk about why this is possible. So I want to review what generally accepted accounting principles say. And I find this very interesting. I found this a very interesting topic, and a few years ago when I wrote an article about this, I actually did one of those things a CPA does, I read the accounting principles behind it because I really wanted to understand what did it say, and then how can we show that simpler valuation methodologies work. So, generally accepted accounting principles say that inventory on the balance sheet must be recorded at cost, just like every other asset. What are those costs? Those costs are the actual expenses incurred to get the goods in condition for sale. So how much did we pay for the materials? What are our production costs? Pretty simple, huh? Yeah. But GAAP also recognizes that it involves many, many considerations. That's in quote because that's what the accounting pronouncement says. what I found interesting about the inventory accounting pronouncement is that it was written many, many years ago, yet at that time, it was recognized that inventory accounting is very, very complex. It's a whole lot different than what are your accounts receivable? What's your cash balance? How much did you pay for machinery and equipment? The other piece of inventory accounting is what is cost of goods sold. Now, accounting and finance people are familiar with the matching principle, which says that you have to show the expenses on your income statement that are related to and match the revenues that you recognize. Simple, easy, sure, but the GAAP goes one step further and recognizes that it's very difficult to match the specific costs to the revenue recognized. And it's because of what the pronouncement says is the continuous nature of manufacturing, that products are not sold in the same period as they are produced, prices change over time, and production costs change over time. And what's really, really interesting is that this is all recognized. And if you think about it, it's virtually impossible to get what is the actual cost of any specific product at any specific time. So what does GAAP say? It says use what's called a cost flow assumption. So this is an assumption about how we're going to show our costs for both inventory valuation, cost of goods sold. Now, the cost flow assumption must be consistent. Companies must use a consistent method over time. You can't simply change year to year, because if you were changing year to year, you could have significant impacts on your reported profitability, which would not be good for external reporting purposes. And GAAP talks about 4 cost flow assumptions. Again, accounting and finance people are very familiar with this: FIFO, LIFO, average cost, and specific identification. So that's what GAAP says. So now let's talk about how we can create lean inventory valuation methods that comply with GAAP. So why can we move to lean inventory valuation methods? First is that one outcome of lean is dramatically lower levels of inventory. When you get to the 30 to 60 day target, you have an opportunity to simplify your inventory valuation methodology and still comply with GAAP. Also, when you have lower inventories, there's less financial risk of inaccurate valuation. For example, when I was a CFO in the 1990s, our finished goods at the end of a month was really all that was sitting in shipping that was going to go out the next day. We didn't have a finished goods warehouse. We made the product and it went out the door. And if the truck didn't show up, we had a little bit of finished goods sitting around at the close of business. And so valuing that finished goods in terms of production costs was very, very simple. So you can use simpler methods. In general, the way you comply with GAAP using simpler methods is you use the average cost methodology. So your inventory and your cost of goods sold is at the average cost of all the goods available for sale. But we're not going to look at it on a product by product basis. And when I did lean inventory evaluation, our auditor said, this is what you're using. You're using average cost, and we will disclose it in the audit report as a change in accounting method in the year we adopted this. It was all quite simple and easy. So let's look at the components of inventory and talk about some ways you can do lean inventory valuation. So let's talk about material first. There's two components to material. One is the quantity of material on hand. And if you have few parts, from a lean viewpoint, you can do a monthly physical. If you have many parts, you can track in ERP. And that's typically what most manufacturing companies are like, because ERP does do a good job of tracking quantities, better than spreadsheets. Cost or price, if you have few parts, you can get an average unit cost or an average cost per day directly from your value stream income statement. If you have many parts, you want to keep the cost or the price of that part in your ERP system because you're tracking it there, but you can switch to average cost or last price paid. And most ERP systems give you the option of, standard cost, average cost, or last price paid. So that's how you deal with material. And it's best to think about few parts or many parts. Production costs, where do we get our actual production costs? Because we got to get the actual and then we average it out. Actual costs come from the value stream income statement. Those are the costs that were incurred in the period. And if you have 30 days of inventory, those are the actual costs that were incurred to produce all the goods for that period. We want to capitalize total costs. So we want to capitalize all of the production costs, not on a product by product basis. And we want to go to a journal entry methodology. Requirements. You can set your labor and overhead rates to 0, which means that in your ERP system, your inventory is just valued at material, and you want to get auditor buy-in on the methodology. And I want to talk a little bit about auditors. I mentioned my story when I did this, that the auditors bought in. If you listen to any other lean accounting pioneers like Gene Cunningham, Jerry Solomon, Ori Fumi, they all worked with their auditors and got them to sort of sanction the methodology so that it's testable. That's really the whole thing. It's auditor, not really auditor approval, but they want to be able to test the methodology. Most recently, I was working with a company last year, and at the end of the year, we turned the labor and overhead rates to 0, and we created a journal entry methodology to capitalize costs. On my last visit there in January, they brought their auditors in. We sat down, we reviewed the methodology, and they were fine with it. And my real point here, and this is very, very important, is that in all the years that I've worked with companies to use lean inventory valuation, the auditors have never said no. They understand this. They like it. It's simpler for them. It's just about getting them involved in the process. So how do we capitalize production costs? We can use a few different methods. We can use days of inventory, units of inventory, or days of conversion costs. Now, what these three methods do is create a ratio, because you have your total production costs, and then you have to determine what percentage of those costs stay on the income statement, what percentage of those costs get capitalized. You can also use another method, which I call historical margins, and I'll give you an example of that. Again, it's very similar to the others, but we try to maintain historical margins. So let's look at some examples. Days of inventory. So on the left is a value stream income statement for the month, so you know what your actual material costs are. The phrase total conversion cost is your actual production costs. We have 20 days in the month. And what do? We calculate a material and a conversion cost per day. And then we know how many days of inventory we have in each of the different types of inventory, raw material, WIP, and finished goods. And we simply multiply our cost per day by the number of days, and we get to our total value, which is $963,148. We see our opening inventory was a little less than $1.2 million. So we know we have to make an adjustment. We have to reduce inventory by almost $223,000. So the journal entry is to credit inventory, debit the income statement, and we have valued inventory for the month. You can also use the number of units of inventory method, very similar to days, but we're using units instead of days. So we calculate a cost per average material cost and conversion cost per unit. We multiply it by the units on hand, and we get to the same number, and we can now make the journal entry. The days of conversion cost method is good to use if you are keeping your material cost in ERP and using last price paid or average cost. What you do is you have your material value and you determine the number of days of inventory. So in this case, we have 11.61 days of material inventory on hand. So what we do is we take the ratio of 11.16 over 20, we multiply that ratio by the total conversion cost to get how much of the conversion cost needs to be in inventory, which is $489,000. The historical margin is about you're trying to keep the margins that you have under standard costing consistent with, or your lean inventory valuation consistent with your standard costing margins. This was a methodology that I worked with in a company because the company and the auditors wanted to do this. So what are the steps? So first of all, you got to calculate what these percentages are. Then what you do is, at the year end, you set your rates to 0 and you revalue inventory. You run the system with 0, and now your ERP system is just showing material cost. Then you recapitalize those end of year production costs with a journal entry. Then you open up your system and you're running just as you always do. It's just with labor and overhead rates for 0, nothing's happening in terms of all that. Then at month end, you calculate the change in capitalization of production costs. Let me show you a simple example. So here, this company at the end of 2016, they had 4 value streams, and you can see that the material cost, or the labor and overhead as a percentage of material, was quite different for each of the value streams. This is one reason why they wanted to continue to use this methodology rather than just an average. So if you look at the T accounts, step 1, revalue inventory, set the rates to 0. What does the system do? It credits inventory for all of the labor and overhead, puts those costs back on the income statement. Step 2, you have to recapitalize those year-end production costs. So you do it with a journal entry just to put the numbers back. So now your end of year inventory is properly stated in your balance sheet. It's just not done on a product by product basis for the labor and overhead. Then at the end of the month, you have your ending inventory, which is a little bit higher than the beginning inventory. Now, again, this is material only. You use the labor and overhead percentages of a material cost, and you get your capitalized production costs by value stream. You add those up, you see it's a little bit more than what your beginning capitalized production costs are. And so what do? You make a simple journal entry. You debit your balance sheet for the $15,775. You credit your income statement. you valued inventory using a journal entry and maintain your margins. So here's some practical advice for lean inventory evaluation. This is a company-specific methodology. I've given you some examples. You're going to have to decide what's best for your company. The whole key and the primary benefit is to capitalize your production costs at a macro level rather than a product by product level. This eliminates all of the settings or standard setting for labor and overhead. It actually eliminates all the variances. It eliminates the absorption. I remember when I did this as a CFO, life became very, very simple in accounting because we didn't have to deal with all these numbers anymore. Keep your material value for the most part in your ERP system. That's probably the easiest for most companies. And finally, I can't stress this enough, partner with your auditors, get their buy-in with the methodology they can test, and it'll be very, very simple to do. So wrapping up, here's what I call the reality check with standard costing and a lean strategy. When it comes to measuring operating performance, using variances and absorption, this is incompatible with lean, and you need to stop doing it as soon as possible. Now, I said the variances may not go away. The absorption numbers may not go away. They'll still show up on the financial statements, but I guess the simplest way is you got to ignore them. You can't use them to try to understand what's going on in operations. You will have to deal with standard costing if you are a lean manufacturing company and you use it. So be proactive in terms of facing the issues and dealing with this. Create a plan, a long-term plan to deal with standard costing. Separate your management accounting system for your inventory valuation method. I recommend doing this early in the lean journey. And finally, for the finance and accounting people, please understand that this is an opportunity to eliminate a great deal of non-value added work in accounting and also in operations. Remember the financial learning cycle when it comes to numbers. Numbers drive our thinking, whether it's individuals, teams of people, or organizations. Our thinking patterns drives behavior. Our behavior drives decisions, and the decisions we make drive the numbers. This financial learning cycle goes on, and in a lean organization, we have different behaviors we want to practice and reinforce. We have different types of decisions we have to make, and so we need the right numbers to drive the thinking, the behavior, and the decisions. Wanted to let you know about our lean accounting community chat, which Mike Paluca and I started last week, had some success, had about 20 people join. We're going to run it again the rest of the month of April. This is the link if you want to join. It's free to register. We limit it to 25 people. We had a lot of fun last week. People asked questions, discussed. We're not doing any training. We're not doing any coaching. It's really just about to get practitioners together to talk about lean accounting. And I wanted to make a few offers through BMA. Our new lean accounting box score product, Lean Think software, has been out for a few months. If you have attended this webinar and would like to use it free for 2020, contact me and we'll set you up. Also, if you want to talk about anything we discussed in this webinar or anything else about lean accounting, a free 1-hour online coaching session is available. All you have to do is contact me and we will set something up. So thanks for attending the webinar. Stay on our mailing list, and I hope to see you in future webinars. Bye-bye.